Welcome to Pinnacle's 2020 Virtual Summit. This session is going to be a little bit different from the other sessions that have been hosted previously in terms of, we're going to have more of a fireside chat with the panelists that we have here today versus having formal presentations. So we're going to do it more of a Q&A style presentation from that side of things with me moderating. We're going to take about an hour of your time today. The first 40 minutes will be me moderating and talking to the panelists, and the last 20 minutes, we're going to focus on your questions. So down the bottom of your screen, you should see a box which has Q&A on it. If you could start typing in your questions there, because I know the panelists are extremely keen to answer your questions, and today is really about you. So we will cover off a lot of the topics. But your questions are vitally important to making this a great session from that side of things. So now we've taken care of the logistics, so let's crack on. So this session is about LICs, or listed investment companies and trusts, and active ETFs. And we'll be covering off, via our expert panel that we have today here, the merits of listed closed and open-ended vehicles, LIC discounts, because I know everyone wants to know about how we're going to try and close the gap in those discounts. ETF performance, during a crisis, so have they really delivered? And a number of other items that we'll get through today. So, send in your questions, and without further ado, then, I'll welcome the panelists. So, welcome, gentlemen. Greatly appreciate it. Thanks for having us here. So I'm just going to kick off with a little intro of for each of the people that are here today. So over the far side at the back, we have Managing Director of Antipodes is Andrew Finlay. So Andrew's products in the listed investment space include both an active ETF and a closed-ended LIC in the global equity space. So a couple of different vehicles there. And we'll dig into the reasons for why those different structures later on. Sitting down the front with the beard is Mr. Chris Joy. He's the Chief Investment Officer for Coolabah, and he operates in the listed space, an active fixed income ETF. Sitting next to him is Andrew Lockhart, the Managing Director of Matrix, who has two fixed income listed investment trusts in his stable. So, ideally we might get a little bit of banter out of these two in terms of, open-ended and closed-ended perspective, although they tell me they're the best of friends, but we'll see how that pans out throughout the day. Up the back and closest to me is Dr. Don Hanson, Managing Director at Plato Investment Management. So, he looks after the Australian equity space and has an LIC in his lineup. And last but not least, in the middle at the back, is Marcus Burns, the co-founder and portfolio manager, or one of the portfolio managers of Spheria, and looks after an Australian small cap LIC. So, moving into our first question, and actually before we get into that, then I might actually introduce myself and talk about why I'm here today. So, my name is Brooks Sweeney. I work for Lonsec Investment Solutions, and I'm one of the senior investment consultants at Lonsec. As part of my role, then I aid with the design and implementation of our listed diversified managed accounts that utilise listed only investment vehicles. So, I'm well placed to be able to answer some of the questions you'll ask, some of the questions for the panelists today in terms of being a user of their vehicles. We're seeing a lot of growth in this area. It's certainly the fastest growing part of our business. The listed space is growing at a huge rate of knots. From that side of things, part of it's due to the number of products that are available ballooning from that side of things, which makes being able to make targeted decisions around exposures that you want in your portfolio more readily available. It's also from an implementation perspective as well. It's great in terms of being able to know what the price is, when you're walking into something from a listed perspective. From an unlisted perspective, then you make the decision, you put in your application to the platform or M funds or whatever it is, And then you've got to wait in terms of waiting for the end of day and the next day to find out what price you've actually got into. So being able to have that ease of implementation, especially for direct investors as well, then is a real key from that side of things. The ETF market is growing at a great rate of knots. So it's around 70 billion at the moment and is growing at about 1.5 billion per month. So that's pretty fast from that side of things. The LIC market is around 45 billion. Obviously being closed-ended, then the market grows from a market return perspective, and also when new LICs come to market, which have been a little bit thin lately, but we can talk to that a little bit later in terms of what's going on and the growth potential for that area of the market. There have been some challenges in the ETF and LIC market in terms of the discounts that have been plaguing the industry. So we're certainly going to talk about that as we go through. And with the abolishing of stamping fees, then what are the implications of that with the development of new products? I previously worked in the UK, which is the largest LIC market in the world. And what we're seeing today and now is that some of the nuances that the LIC market in the UK brought to their market to reinvigorate it are starting to flow over into the Australian LIC market. So we're going to touch on that as well. So without further ado, then we'll get into our first question, which is for Andrew Finlay from Antipodes. Of the panellists, you have had listed funds the longest, and you have an ETF for your long-only product, but you have an LIC for your close-ended long-short strategy. Why did you decide to go for both a listed and an unlisted? Well, sorry, they're both listed, obviously, but an open-ended and a closed-ended structure for the different strategies?
Well, each structure has its own characteristics, and you're right, we have our global long-short strategy available in a listed investment company format, that's ticker APL, and our global long strategy available in an active ETF structure, ticker AGX1. APL being a company, its board can choose how much of a dividend to pay each financial year, and shareholders of APL are attracted to a consistent and steady income profile with franking credits attached, given it's a company structure and pays tax. Also, the closed-end nature of an LIC is appropriate for our short positions and various other tail risk hedging techniques we include in our sort of more absolute return style of global equity investing. So the income in combination with long-term capital growth from global equities fits well within a closed-end LIC structure. The active ETF is has become more prominent recently, and it's a fantastic innovation, I think, for the Australian market. We're one of the few markets in the world that offers this particular structure. It's effectively a managed fund, albeit dealing to a lot of those issues with managed funds that you managed before. You can effectively buy and sell at any time during the ASX trading day and get a price then and there. And that's a perfect vehicle for our global long strategy. Ultimately, every structure, LIC, LIT, active ETF, has its own characteristics, and I think they'll all grow in their own way, fitting different investor profiles, preferences, as well as different investment strategies.
Excellent. Yeah, thanks for that answer. We're going to dig into some of those nuances a little bit later in the piece, but before we do, then I thought I'd switch from the equity side to the fixed income side. So my next question is for Andrew Lockhart. Two Andrews today, so that always makes things a little bit interesting. So Andrew Lockhart, your organisation, Metrics, operates a closed-ended listed investment trust. Why do you think that that structure is appropriate for the Australian fixed income or loans market?
I guess in terms of our activities, we're very much private market direct lenders, and so we're out originating transactions directly with Australian companies. And as a result of that, the assets and the loans that we make to those companies are not readily tradable. You can't buy and sell a loan over a screen. And so the ability to give investors access to what we think is an attractive market in terms of the risk profile and the returns that are able to be generated in a format or a way that gives investors control around the liquidity of their investment, I think is important. And so from our perspective, what we've sought to do is just simply raise capital through the closed-end LIT structure, using those proceeds to lend to Australian companies, and as a result of that, giving investors that would otherwise not accept or look to invest in that asset class a means to access the asset class and to invest because they've got liquidity. So our various funds have just simply sought to segregate risk, return, and provide different ways in which investors can gain liquidity and access to the market. And so as a result of that, a listed vehicle is just one piece of the overall puzzle in terms of how investors can gain exposure to our asset class.
Excellent. Thank you, Andrew. You're touching on liquidity and illiquidity. Then I might ask the next question of Dr. Don. In terms of, you've got an Australian equity LIC that operates in the more liquid space in terms of the ASX 200. Why is a closed-ended structure in the LIC appropriate for your product?
Well, it's not about, liquidity is one reason to have an LIC or illiquidity, but it's not the case that we brought our fund to market. A listed investment company is a great way of being able to bank dividends because it's a company, so it can have retained earnings. But also, I think importantly, bank franking credits, and you can have a franking credit balance that you can bring forward 1 year to the next. So it's a great way of smoothing income. And what we've found is that a lot of clients, particularly retirees, like regular sort of monthly income, whether it be dividends or interest or what have you. And PL8 is the only listed investment company that pays a regular monthly fully franked dividend, and clients love that. And we were able to bank some great dividends from the dividend bonanza last year to help tide us over this year, where it's going to be a bit, I think for the next couple of years, going to be a bit of a struggle. But you're able to actually do that smoothing and bring that forward. A trust structure, whether it be listed or unlisted, doesn't really give you that flexibility. You can pay capital, obviously return capital, but you can't bank franking credits, for instance.
Excellent. Thank you, Don. I'm glad you touched on dividends. Certainly, dividends are more hard to come by these days with the banks being forced to cut their dividends due to regulatory reasons from that side of things, and certainly from a business perspective in other areas. So that smoothness of return income in that structure can be quite helpful. Next question is for you, Marcus. Small caps. So, why does it make sense to have a small cap fund wrapped up in an LIC structure?
Well, look, it's a good question. And I think, we would answer a bit the same way that other people do when they talk about liquidity as well. So, we've got a variety of stocks that range from, the upper end of the small cap spectrum, around 3 billion market cap, right down to, some micro caps that are, around the 50, 60 million market cap range. And they're definitely less liquid than than the regular small caps. We've got the capability to move down to that spectrum, move around the space from right down the very end to mid-level to upper end of that range, and take a longer term view, I think, which is really what I think we can actually arbitrage the short term nature of the market right now. We've seen a good example of that over the last 12 months, where there's been a big flurry to stocks don't make cash flow earnings, and retail investors got involved in the marketplace and pumped up a lot of areas to crazy valuations in our opinion, and left behind stuff that we think is incredibly good opportunities long term. So we've been able to move the fund around, take advantage of that, and I think having an LIC structure which gives you holding a duration, we've been able to take advantage of that opportunity basically. So I think it's a good place to be for an LIC, and it suits us well, I think.
Excellent. So we're going to move on to the next area or next topic for conversation, which is around those LIC NTA discounts, and also the potential growth in that segment of the market. And we're going to dig into a few questions around the small cap space as well. But before we do, then I thought I might set the scene a little bit. As an independent consultant, then setting the scene from a user of these kind of products, then I think it's pertinent to frame these NTA discounts in terms of what we've seen historically, and how we kind of think things will move forward So really what it comes down to, during the last significant downturn, aka the GFC, so the one before our COVID-induced market event, then we saw discounts in the LIC market even steeper than we had back in March. For the vast majority of portfolios, then that discount has reduced. There are some stragglers out there where those discounts haven't evaporated as much, but there certainly has been a pullback towards their net tangible asset values versus where we were at the depths of the crisis. And part of that's cyclical. It's a little bit like the Australian dollar in terms of, it likes to overshoot and undershoot. And that's kind of what we're seeing in this part of the market. The other reason is that there's an element of price discovery as well. So for global LICs, then they operate in a lot of markets where the markets are closed during the Australian trading day, which means that it's price discovery and people making a guess on where they think international markets may or may not move the next day as those markets are closed. In the fixed income space, I'd like to say that the Australian corporate bond space is more liquid than it really is. So, price discovery becomes important in that fixed income element because liquidity is not always there in the corporate bond space. So, what you're seeing is people, the market deciding what they believe the price for bonds should be versus what they're actually seeing from a physical perspective, because if you're selling corporate bonds into the market that we had through the GFC or through COVID, then you're going to take a pretty hefty hit, and therefore liquidity liquidity starts to dry up. So those are some of the reasons that you see some of the discounts, and certainly post the Reserve Bank coming out with a number of support mechanisms for the fixed income market, and as more information has come to market, then we've certainly seen a lot of those discounts to NTAs shore up in that fixed income market. So, without further ado, then I'm sure you've had enough of listening to me. Then we're going to move on with some of the questions. So we're going to kick off again with you, Andrew from Antipodes, I should say. At various times, the Antipodes LIC has traded at a premium of up to 5%, and also at a discount of around 20% over the 4 years of the life of the company. What do you think has driven that? And what are you doing about trying to shore up that NTA discount?
Well, as you suggest, Brooke, NTA premiums and discounts are largely cyclical through time. I mean, there are certain company-specific factors. In our case, a value manager in an environment that's had plenty of style headwinds for our investment style hasn't helped. But NTA premiums discounts are cyclical through time. We see that in all closed-end fund markets around the world. That's both a shortcoming, but also an opportunity in the closed-end fund world. I mean, if you consider APL today holds roughly 60, what we believe very attractively priced companies all over the world, you can buy that already sort of attractive portfolio at an even greater value or discount today. So that's an opportunity certainly that some advisors and investors are taking advantage of in this space. Notwithstanding the cyclical nature of NTA discounts, it's important that all LIC boards seek to address any persistent discount, and certainly the board of APL, of which I'm one of the directors, has aimed to tackle that in APL's case in a number of significant ways. Firstly, through an on-market buyback. Late last year we launched that on-market buyback that amounts to over $100 million. So it's one of the largest, if not the largest, LIC on-market buyback ever to have taken place in Australia. And more recently, we announced an innovative conditional tender offer initiative, which follows research we've done into other closed-end fund markets around the world. You mentioned you worked in the UK previously, and this is a feature of that market. Essentially, it involves the company conducting an off-market buyback for up to 25% of the company's shares at regular intervals through time, subject to a discount persisting over a 12-month period. We think that's a great balance, or offers a great balance between long-term shareholders who want to stay with the company, as well as offering other shareholders an opportunity to exit at near NTA. Over the very long term, though, it's really investment performance and market demand that we think drives NTA premiums and discounts through time. So to that extent, the Antipodes investment team's clearly very focused on generating that performance, and notwithstanding our value tilt, we think over the long term we'll be able to deliver strong risk-adjusted performance. And together with our colleagues at Pinnacle, we're really always trying to enhance our investor communications and drive that demand for APL shares through time.
Excellent. Thank you, Andrew. I think maybe Chris might have something to say about my comments around the cyclicality of the LIC market, or...
Not really, no.
No?
No, I mean, yeah, I think that the discounts that emerged in March in ETFs and LICs were, clearly driven by the stress and the illiquidity of those asset classes. And a lot of those discounts have closed back up, so they've disappeared. Certainly in the ETF world, the discounts have disappeared. One of the things we have seen is that the NAVs in fixed income in March were stale, so they were old, and they weren't reflecting proper pricing information. We can talk about this later, but we run an ETF, an active ETF, HBID, and it's probably the only fixed income ETF in the world that didn't trade at a consistent discount to NAV, because it holds liquid assets, and I think people were very comfortable with the valuation of those assets. The Bank of England, Invesco, and I think the Bank of International Settlements have looked at this question as to why discounts emerged, and they put it down to illiquidity, which is, I think, what everybody is saying. And their conclusion was fixed income NAVs, many of them were meaningless in March. But as liquidity has come back into the market, that hasn't been a problem. We specialise in liquid assets, so I bought and sold about $1 billion of bonds in March, and we've traded about 14 billion in the last 8 months. So illiquidity is not a problem for us.
Excellent. Right, my next question is for Marcus in the middle. So, speaking of discounts and liquidity issues, I mean, small caps is synonymous with being potentially having a little bit less liquidity than other parts of the market. So, to be honest though, most small cap LICs have been trading at a significant discount for a while, including SEC, which is your vehicle that you operate. Mm-hmm. Just wondering whether this is an opportunity of a lifetime in terms of get in now, or are there some other issues that are causing that continued discount to NTA?
Well, they say you should never ask a barber if you need a haircut, because the answer is always yes, right? So in my case, clearly it's the opportunity of a lifetime. We're a massive discount, and you're buying, a bit like Andrew's point, buying good assets cheaply, cheaply twice, because we think that obviously they're attractively priced, and then obviously the LICs are a discount, so you get a double entry discount, and effectively, if you think we're doing a good job on what we're doing with our research, which obviously we think we are. There's a couple of things I'd say. That one is, I think to the point that Chris made earlier, I think there is some cyclicality of the area. So you've seen a lot of other supply issues come on. So ETFs and their coterie are kind of obviously creating a bit of other way for people to access the marketplace in listed format. LICs, I think that supply demand dynamic will eventually correct itself. Your point about no stamping fees means that supply will be dramatically reduced. Activities like ours and like Antipodes, where we buy back our stock, means that we're shrinking the supply out there, so that'll also reduce supply a bit more as well. And then obviously over time, the better ones will survive and thrive, and the weak ones will probably be taken over or eventually roll up in some other way. So I think supply will kind of naturally correct for the demand. And then there's things you can do to self-help, like buybacks, and then a lot of things that we've been doing, like increasing transparency. So we now give the top 10 holdings, which comprises around about 45% of what we actually own. So you get a lot of visibility into what we own every month. We give daily NTA updates now to the marketplace, which give huge visibility on what's going on. And then there's just a ton of value in what we own, not only in the actual stocks we own, but there's a lot of tax credits and other things that you don't see in the NTA that that mean there's investors getting a lot of value in what we own. We bought back roughly 7% of the fund, of the company, sorry, since it IPO'd about 2.5 years ago. Their buyback's ongoing, and then I think performance is improving, and you'll see we're entering a phase where we think managers like us who are active, focused on cash flow, should do really well versus a lot of the marketplace, especially in smalls. We've got a huge amount of speculative activity going on. So I think we're a much better place to be putting your money than a lot of the stuff that's run really hard in the small cap space that doesn't have a lot of fundamentals justifying it. So
yeah, I mean certainly that cyclical nature comes back to the fore in terms of what we see as an investment consultant. Then small caps have a tendency to be a little bit less loved at the start of recoveries, and then as the recovery takes shape, then people get more comfortable around taking risk outside of tech names, and the market broadens out from that side of things. So certainly from a consulting perspective, then that rings true that cyclical element is probably more prominent for the small cap space than other areas. So switching angles here a little bit, and in terms of looking at the fixed income space, so Andrew Lockhart has an LIT fixed income one. It's trading at I believe it's still trading at a discount at the moment. What is your view on this, and what has kind of driven that discount?
Yeah, look, I think it's interesting. We actually have two LITs. The MCP Master Income Trust, which is MXT, which was designed to provide investors with an alternative to traditional fixed income, and designed to provide a more defensive part of investors' portfolio. The MCP Income Opportunities Trust, MOT, was the second LIT that we actually launched to market in April of 19, and that's designed to provide investors with not only an attractive equity-like income, but also potential to participate in upside capital gains. I actually take a different view. I think that through the early period of March and April, I think that there was generally fear within the market, and people were selling all assets indiscriminately and moving to cash. We don't have the benefit of an ETF market maker, and so obviously there's a natural buy and sell, supply and demand that creates an issue in relation to the traded price. But certainly from our perspective, we put out a daily NAV. It's important that I guess investors understand where we sit in the capital structure. We're not equity, and as a result of that, equity should wear the risk of loss. In fact, what I had hoped occurs over time is that when there is a need to go to a flight to quality, I hope that MXT is a beneficiary of that rather than investors selling out. And so I think that if we can continue to diversify our portfolio, continue to manage credit risk, continue to deliver attractive returns, then over time you continue to generate and garner investor support. MXT has obviously traded back close to its NAV now. It was at a discount, and when you look at the world of comparable assets and risk, it's obviously generating an attractive yield for investors for that risk. Importantly, I think governance has been a big issue. So when I think about the competitor fixed income or credit LITs that came to market after the launch of MXT and MOT, they were giving investors exposure to a very different type of asset class, predominantly public market traded securities and offshore. So you sort of question as to why some of those vehicles need to be listed in the first place. People can buy and sell US high yield notes if that's what they want to do on a regular basis without requiring it to be in a closed-ended LIT structure listed on the Australian Stock Exchange. But certainly our activities removes currency risk. It removes the volatility of public markets. We're a genuine market liquidity provider to Australian companies competing against the banks. And so I guess what I would sort of say is when you look at the asset class and the protections that are afforded to investors in our asset class, so as a manager, it's a big part of our responsibility to negotiate appropriate terms, conditions, appropriate covenants and controls, taking security to mitigate risk of loss. And so when we put out an NAV, investors should have confidence that the value is correct. And part of that is about ensuring that we've got an appropriate governance system. And so the value of our assets is valued on a daily basis tested for impairment or the risk of credit loss on a daily basis, which is then independently overseen by a major international accounting firm on a monthly basis. So from an investor's perspective, there can't be any dispute as to the governance or processes. In fact, when I look at our funds, there are a number of our funds where we've seen 30 to 50% of the portfolio churn over the period of March through to the end of August. So a highly liquid, repayable exposure at par. And so I would always say, unlike equities, where there is always going to be some subjectivity as to the valuation of a company, with debt, if a company owes you $100, at the end of the maturity of that loan, the company better pay back the $100. In which case, if all we need to do is simply accept repayments in relation to the loans that we've made, go to cash, I'm sure the discount would resolve itself. So I think from our perspective, it's important to continue to inform, educate, and demonstrate consistency of performance for our investors. And I think over time we'll gain that market support.
Excellent. Andrew, I'm guessing you weren't invested into Virgin then, because I don't think you got 100 cents back in the dollar for the bonds there.
Interesting you say that. So I guess we had a number of investors that asked us at the time, would we invest in Virgin? When we looked at that, and you look at the credit structure and where you sit in the capital structure and you complete your credit due diligence, there was no way known we were ever going to be investing in a company like that, no matter what the yield was. And quite frankly, we thought it was a mispriced return for the risk that investors were taking. And certainly the outcome for those investors clearly demonstrates in our mind why investors are often better going into a pooled, listed fund with professional management, professional credit expertise, and those that can originate transactions and manage risk directly with companies, rather than individual investors buying one-off corporate bonds. I think there are far better benefits to investors in being in a pooled scheme that can provide diversification, can provide access to professional management to manage that risk.
Excellent. Andrew, you're clearly on message today. Chris, would you have any additional thoughts to what Andrew has said?
I can't really comment on his products.
No.
I can talk about my
that
products.
side of things.
So we run a active ETF, HBID. It's the fastest growing active ETF in Australia, and I think it's attracted a lot of capital because we've basically delivered the returns of the hybrid market, only being 85% invested, net of fees, and we've had lower volatility than the hybrid market. And in March, it was very interesting. We saw hybrids fall about 6.5%. Bank stocks were down 25 to 35%. High yield bonds, which Andrew referred to, were down about 15. The listed high yield bond LITs, I think, were down about 25. HBID was only down 4.5% net of fees. So outperformed through that period and consistently traded at NAV. So as I said before, I think it's the only fixed income LIT or ETF, it's an ETF, not an LIT, that traded at NAV throughout that period. And for us, we knew the NAV was right because we're trading liquid assets. We also have a lot of liquidity in HBID. So we actually invest in senior bonds, subordinated bonds, and hybrids, and we transact with over 50 counterparties. So we have better liquidity than the overall hybrid market.
Can I close you off there in the
sure.
interest of time from that perspective? Certainly from thinking about the metrics products, then there was a couple of investment committees that I sat on and looked at the discounts that were that Andrew's products were trading at, which evaporated quite quickly as more information came to market. But I think we might switch tracks here, and we kind of talked a little bit about stamping fees and the ban that has been put in place by ASIC. So Don, just wondering if you want to talk about a little bit about your LIC and how important it is for you to grow your LIC, and whether these bans on stamping fees cause you any concerns or issues, or you think it's an opportunity?
The first question about growing the LIC, I mean, our LIC is fairly large already, quite liquid, and despite a lot of other ones around here, it's actually been trading roughly at NTA or indeed a slight premium to NTA, so it's been well supported. Look, there are economies of scale are growing, which is actually interesting. There are, a lot of your fees are fixed, so there are some benefits in growing that, which is a bit of a rub. Is that if you actually reduce the size of your LIC, it can go the other way. But look, we're not desperate to grow that fund, but it does. The question I raise is how can we grow that fund? I think it's yet to be seen how good the market is ex the stamping fee ban. We've sort of looked at it in terms of possibly doing the next, if we were to raise money, look at an entitlements type offer where we wouldn't need to encourage the sort of people to look at it.
Excellent. Gentlemen, any in the back row being the equity guys, any thoughts on that?
Look, I think it's a good thing, frankly. I mean, it's obviously going to be harder for people to launch additional LICs if they can't do stamping unless there's a really compelling reason to invest in it. And I think that's probably net positive. Yep, we're trading a discount, but that means we're attracted to be buying right now. I mean, it's, and I think that one thing that does count against us is our size. We only have about roughly 110 million market cap, so we're, less liquid, but, we should be able to grow if there's demand over time. Investors want our stock, and if we trade up at levels close to NTA, I think it'd be worthwhile doing a placement if it made sense, at the time. And I think stamping fees are probably have helped create the inefficiency we're seeing today in the marketplace, frankly, is my feeling.
Excellent. Right. Andrew, you okay? I might actually switch it back in terms of going back into the fixed income space and ask Andrew Lockhart in terms of whether what your thoughts are on the size of vehicles in the fixed income space and whether that's important and whether you think the stamping fees are going to be a boon or a challenge for yourself.
I think in public market fixed income, size and scale is not as relevant as it is in private markets. So we compete and lend alongside banks. Compete with and lend alongside banks. And so size and scale is very important to us. We believe that size and scale actually improves the investor outcomes, not only in terms of better risk management, because you're in greater control of the origination process, you're more relevant to the borrower, and as a result of that, you can negotiate terms and conditions to mitigate risk. But because you have a sizable amount of capital to deploy and being relevant to a company, you're bringing your investors closer to that point of origination where you capture the origination fees and you set the terms and conditions and pricing. And so we believe there are benefits to investors in terms of both risk management and better returns, and also from a pure diversification of credit risk. Obviously, one of the greatest risks that an investor is exposed to investing in our funds is the risk of credit loss. And so you want to lower the risk that you have to any one individual borrower, and so size and scale is important to be able to achieve those outcomes.
Excellent. Thank you, Andrew. Greatly appreciated. We might switch track a little bit here. We've been fairly focused on the LICs and that part of the markets, LITs as well. So we might touch on a little bit more around the ETF market. Chris, then that's your space. So ETFs have been booming, but a lot of it has been in more of the passive space versus the active side of things. It's been a little bit patchy, to be honest, on that active side. Your product, HBID, is a bit of an exception, as you've touched on before. How have flows been, and are the kinds of investors that are investing into your product from a listed perspective different from the managed funds universe that you also operate?
Yeah, I'm not exactly sure why the product's done so well, to be honest. It's obviously performed well. It's very liquid. As I mentioned, it's traded at NAV. I think people in the hybrid space want an active approach. I think they like the fact that we can go full capital stack, so cash, senior, sub, and hybrids. Hybrids are very complex securities, so I think that, as Andrew was saying, they want active professional management to help them price the securities and build a kind of 40 security portfolio. I think the flows have been fairly similar to our other strategies, but it is quite formidable and impressive. I think we've probably only had 10 net redemption days in the last few years, and we did see redemptions in March. So we had about, I think, 30 to 50 mil of outflows in March, but we bought a lot in March as well. So I think I bought about $300 million of hybrids in March. for that portfolio and for the other 19 portfolios we run. And the returns that we captured, hybrid spreads went out from 270 over bank bills to about 840. And so we've actually realised returns of 15 to 25% on those distressed prices in March. But they are very liquid, so people often ask me, are hybrids are liquid? In March, we saw more than 100 million a day of hybrids trading. So there's actually, because you have the ASX aggregating buyers and sellers, there's a lot of very transparent liquidity. It's quite interesting because, as you mentioned, in the corporate bond market, there was almost zero liquidity in March. That wasn't true in the bank bond market. So we are also the most active participant in repo eligible bank senior paper, and we probably traded 700 million of that in March. And we actually had negative transaction costs across all of our buying and selling in March. So liquidity is, I think, a pretty nebulous concept. There are parts of the bond market that are highly illiquid. There are other parts that are very illiquid. I do think the future is active ETFs, and I think investors, you put it best, that real-time digital execution, they love. And I think you'll see more quotable funds like the Airlie product that Magellan has launched, where you have the option of being both unlisted and an active ETF.
Cool, excellent. Might move on in terms of one of the key attributes of ETFs is that there's a market maker that's in place. I might ask Andrew from Andrew Finlay to talk about that in terms of whether you thought that the market makers helped or hurt your ETF through the recent dislocation that we experienced.
I should just preface this, my response to that question by saying there's a big difference between let's call it passive ETFs and so-called active ETFs, where the market maker is an agent of the fund. So in our case, we appoint a market maker to make prices around an indicative NAV, and therefore during the course of the market dislocation back in March thereabouts, it functioned very smoothly. We continued to quote an indicative NAV every 15 seconds throughout the trading day. We think we employ a very much a best-in-class approach to calculating our INAV. We use futures to proxy the prices of offshore equities in markets where they're closed. Not every active ETF does that. And the market maker has instructions to offer prices at a tight spread around that indicative NAV. So in effect, investors had access to managed fund-like pricing, bid-offer spreads, on market that were updated every 15 seconds throughout the trading day. Subsequent to that period, we've now moved to 1 second INAV publication, so that's in line with market best practice. And I think that structure, as Chris has intimated, is a great structure. It has lots of benefits. What I've just explained for an active ETF is different for, let's call it passive ETFs, where market making is done on a sort of third-party basis, and that's where you get the big discrepancies between traded price and NAV.
Excellent. Thank you, Andrew. Greatly appreciated. I've got to admit, I didn't know that you had moved to 1 second. That is impressive from that side of things. So it's good to see that the things are certainly moving forward from a best practice perspective across the market, and your products kind of leading from that perspective. Excellent. So I might actually switch over now to the Q&A part of the session. We've had a lot of questions which have come in. So our first question is from George. It's a question for Chris at Coolabah. Chris, you've been a vocal critic of LICs in fixed income. Do you still have this view, and will you ever consider an LIC or LIT or for any of your strategies, or is it not the right structure for bonds or for your bonds?
Well, I think that I was actually a vocal critic of conflicted remuneration around LICs. And I was pretty clear saying there's nothing wrong with LICs. And I think there are great LICs, and I think the metrics solution where you have illiquid loans and the only way for retail to access that through an LIC, that makes perfect sense. We have been offered, contrary to some counter arguments in the conflicted industry, we were repeatedly offered the opportunity to do LICs or LITs. It wasn't right for us at that time. We had an active ETF product, HBID, that was booming. We run north of 4 billion across 20 strategies, and have no issue raising listed or unlisted capital. So I wouldn't rule out an LIC or a LIT in the future, but there'd have to be a really compelling value proposition for investors. And again, I think private credit, it makes absolute sense. It's sort of incontrovertible. I think Andrew's sort of criticism of the other fixed income LICs out there, I think that was a pure money grabbing exercise. Like a pure unadulterated, let's raise as much FUM as possible on the highest possible fees. I mean, it was crazy. I mean, those products were raising, products that hadn't raised much money from retail, like big global, I won't name them, but big global shops that had consistently failed to raise money from Aussie retail. We're raising vast quantities on vast fees for levered high yield bond strategies in a matter of days. Now, those products, I think, were sold actively. They weren't bought. And I think the fees had a huge role to play. And it's not surprising to see all my LIC peers say, oh, guess what? There aren't going to be many LICs coming to market. Why? Because the fees aren't incenting those opportunities. But I think really good LIC managers, like some of the guys here, like Metrics, will actually have the ability to raise capital in the listed domain through secondary offerings, because there's clear pent-up demand for liquefying or equitizing, whatever you want to call it, or securitizing, really, a portfolio of liquids through a listed structure.
Excellent. Thank you, Chris. Funnily enough, our next question is from a Chris, and it's a question for Don at Plato. A fairly technical one, actually, Don. Would you agree that the AMIT tax structures, I think you might have to explain that to people before we go too much further, has it been a game changer for managed funds or ETFs' ability to smooth income? We kind of touched on the smoothing of income before. Can you go into, or maybe explain AMIT, because I'm guessing a lot of people out there are not abreast of the changes and regulations which have occurred.
Well, I'm not an expert in that you really have to go to the accountants, but my understanding is that it just makes it easier for companies to over-distribute income or undistribute or return capital. But what I am led to believe is that whilst you can return capital to investors under this regime, you can't really bank franking credits from year to year. So, it goes partially to that way, but particularly for franked income, I don't think it actually gives you as much flexibility as what it's been sort of made out to be.
If I'm rereading this question, I think we touched on it before in terms of within the LIC structure, you can have that smoothing of returns. So if I'm hearing you correctly, and what the question I think is asking is that now with the AMIT within the managed fund structure, you can smooth things a little bit more. Is that? My
understanding is, it makes it easier for you to pay, say, a regular distribution. But that distribution, if you don't have enough income in the year, you're actually returning capital. And
which has been an industry concern for
I think a lot of people don't like to eat their own capital, because it's a slippery slope. If you started digging into your capital one year and next year, ultimately the income's going to fall out. Whereas I think people are much more comfortable in receiving actual income each year, and particularly if the asset class you have has franking credits, and people love franking credits, they get that credit, etc. And I don't believe you can bank them under AMIT.
Excellent. Thank you, Don. A cheeky question for you, Marcus. Across your range of funds at Spheria, where are you putting your own money?
Cheeky question indeed. Look, where am I putting my money? My money is invested in microcap and small cap right now, and I think the best opportunities are actually in those two funds. Just given what we've seen in the marketplace, we've seen a very weird. I gave a presentation yesterday talking about a topsy-turvy market where we've seen a lot of retail investors, I think, coming to the marketplace and buying so-called disrupting stocks, so stocks that look like BNPL, which we've now dubbed the buy now, profit later sector. a bunch of other stocks that look like fast-growing fintechs with, minuscule revenue lines and very large market caps. And it's just honestly ludicrous. They're going to implode at some stage because, whenever you had a business that makes nothing worth a ton of money long term, you have it for a very long period of time. So that will unwind. And I think on the flip side of that, money's to come out of areas where you've got really good businesses. They might be slightly more cyclical. And I think people have fled cyclicals. They've fled smaller companies. A lot of them have got net cash balance sheets, very good long-term business opportunities and trading at very big discounts. And so, our microcap fund's got that stuff in it. So is the LIC, SEC, and so is our small cap fund. So I think that's the best place to be at the moment, in my opinion.
Excellent. Thank you, Marcus. We've had another question come through from the audience, from Darcy to anyone on the panel. So this is kind of an open slather one here, gentlemen. Are ETFs a better structure for liquid assets? Put it another way, why isn't LIC an appropriate vehicle when the underlying assets are liquid like equities and bonds? Does anyone want to have a crack at that?
I'll take it on first, and there's many different ways to answer that question, but I go back to what I said earlier. We have a managed fund for our global long-short strategy. We have an LIC for our global long-short strategy, APL. I can buy exactly the same portfolio at a discount today in the LIC. So it's an attractive investment opportunity at this point, and I've certainly got most of my money invested across our activities products into the LIC at present. But at the end of the day, each structure has its own characteristics. The benefit, or one of the key benefits of an LIC, even for liquid asset classes, is that you have this additional sort of corporate layer or company layer. So there's company management issues, which both gives rise to opportunities, and the investment portfolio driving the primary source of return can be distributed via dividends at the election of the board. So if you're up for dividend smoothing, as Don's talked about, LICs offer a much more smooth income profile than a managed fund will, which, according to trust law, has to distribute all realised capital gains and incomes each and every year. So the income profile can be quite lumpy.
Excellent. Thank you.
Can I say?
Yeah, certainly.
I think LICs are good for sophisticated investors. So the discount is an opportunity for someone who's not currently invested. But for somebody who bought it at IPO, the discount is a huge drama, right? So the fact that 70 to 80% traded discounts, the fact that the discounts blow out in bad markets, that's not a good thing for retail, no matter which way you slice and dice it. But I think for smart investors or sophisticated investors, if they can exploit those arbitrages, that's a great opportunity, right? And then if you've got a liquids, I think LICs have a really valuable role to play. But I think an objective analysis would be that most of the time, the LICs are good for the fund managers, not so good for the retail investors.
In public market securities.
Yeah.
So I think clearly, the number of offshore global LITs that came in credit were trading in public market securities.
Exactly.
Investors could gain liquidity from the traded nature of the assets, which probably lends itself more to an ETF structure than a closed-end LIT. As Chris says, the closed-end LIT was a great structure for those managers capturing closed-end capital to invest in public, liquid, tradable securities. In the case of Metrics, we don't have the ability to have regularly tradable assets, and so we can't have a market maker that can buy and sell those assets to create liquidity for investors. So the closed-end structure is an appropriate vehicle to give investors access to the asset class without the risk of illiquidity.
Excellent. Great answers, gentlemen. Probably the one that I would touch on with my kind of background in the UK is around that sophisticated investor market. So in the UK, as I said previously, the LIC market is the largest in the world, and certainly it is actively contested in terms of sophisticated. I'll wrap my mouth around that one. Operating in that market, seeing the discounts to NAV or NTA, sorry, and going into those to try and drag those closer. So it's great in terms of what Antipodes is doing, around trying to bring those NTAs back towards par from a board perspective. But yeah, potentially as the Australian market becomes more sophisticated, and there are more LICs around these days than there were previously. So we might have more investors looking to jump on what is really an alpha potential there. Should mechanisms be put in place to drag net tangible asset values back towards their par, and certainly that cyclical element can play a role as well. So I have another question coming in from Sam for Andrew Finlay at Antipodes. Have you considered introducing a mechanism for shareholders to exit if the discount doesn't narrow? So we kind of touched on that a little bit before, but
Yeah,
maybe
absolutely. So that was the conditional tender offer that I mentioned before, and as we've spoken about, that's an innovation, first ever time that's been done here in Australia. It's to be put to shareholders in a couple of months' time at our AGM. That comes from the UK market, where we've seen it operate successfully, and that'll enable shareholders to exit at close to NTA for a minimum of 25% of their shares.
Excellent. A cheeky question from me next up to the other Andrew Lockhart. If you were thinking about raising another fund, would you go listed or unlisted, and what would drive your decision to go one way or the other?
That's interesting. We've actually launched a most recent fund that we launched is a retail unlisted fund called the Metrics Direct Income Fund. So recognising that investors want choice, so realising that some investors want the daily liquidity and to have the ability to buy and sell on the stock market. Those investors obviously understand that part of the risk is the traded nature of the units on the exchange. So that is a risk that we sought to remove by coming out with the unlisted version. Now, an unlisted version for retail clients in our asset class is very difficult to achieve liquidity until you've got to a size and scale. And so one of the benefits that we're able to pass through to our investors as a result of the growth in the business of metrics and the size and scale of our funds is the increasing level of liquidity of our portfolios. And so as a result of our size and scale, we can offer liquidity enhancements to investors. We certainly couldn't have come out with a retail unlisted version for clients offering liquidity in our asset class until such time that we had achieved greater size and scale through the listed vehicles. And so from our perspective, we're agnostic as to which vehicles investors choose. We simply try to create attractive investment products where an investor can determine what is their risk tolerance, what is their return objective, and then what do they require in terms of liquidity. Some investors are quite happy to have less liquid investments, and they're in the wholesale unlisted funds that we operate. With the retail funds, we recognise that a lot of retail clients and self-managed super fund clients want greater levels of liquidity optionality, and so one was the ASX listed fund where they can buy and sell on market on a daily basis, and with the Metrics Direct Income Fund, the retail unlisted fund, investors in that vehicle have the ability to redeem or get liquidity in their investment on a monthly basis, which we think is an attractive option.
Well, can I just add something there?
Yes.
I mean, I think one of the key factors driving the growth in listed investment offerings, regardless of structure, is simply technology. In order to maximise efficiency through the chain, exchange traded offerings enable straight through processing. Managed funds world is somewhat archaic and expensive, and over time I'd expect the industry broadly to move towards more on-market investment offerings for that reason. I mean, think about, I think somebody mentioned earlier, the apps and things that we use today. In order to buy and sell something on our screens right here and now, it really needs to have an exchange listed instrument at the end of the chain to enable that to happen.
Yeah, certainly. I mean, for us, then, the efficiency aspects are quite nice, and the transparency as well, comes into the fore. I mean, they say we live in the age of disposable tissue as well, in terms of, more instant gratification from that side of things. But you do get that transparency and ease certainly, we've seen, huge growth in the self-managed super fund space in terms of, people wanting to invest directly themselves through those kinds of structures. So I tend to agree, and I mean, you've got to look at the growth of the market. 70 billion for ETFs already, 1.5 billion a month is quite a rapid pace from that side of things. And certainly as we work out some of the nuances around the active ETF spaces, it looks like the regulator is a little bit better at understanding that space after having paused, stopped allowing new active ETFs to be listed, probably 18 months, maybe 2 years ago. So there's an interesting area, and it certainly we're seeing large amounts of growth in that listed space for our business at Lonsec. I have another question coming through, and I apologise. I'm probably going to butcher your name, but I'll go. So I believe there's a question from Samweni. It's a question for Spheri, and maybe Don can jump onto this one as well. So first to Marcus though, what was the difference between how the NTA discounts on small cap LICs like SEC performed during the COVID sell-off compared to the larger cap LICs?
Okay, look, the honest answer is I don't know the exact difference in performance. My suspicion is that the small cap discounts widened more than the large cap. Certainly, if you look at the indices, the micro cap small versus the large, the indices underperformed. So smalls and micros underperformed the large during that sell-off, and then aggressively recovered that. And so micros particularly has actually massively outperformed since the bottom of the sell-off in late March 2000 this year. So that's the first part of that question. The second, I guess, is really our fund, the way we invest, is designed to actually perform. In theory, to perform well during sell-offs. We buy cash flow companies with good balance sheets. We do valuations. Unfortunately, over March, we did actually fractionally underperform, and that was because we had exposure to tourism and leisure. So even though they made cash flows, the economy was shut down in parts more than others, and tourism and leisure was particularly hit. So we had some exposure to Village Roadshow, one or two of the corporate travel stocks that actually got hurt more than the market over that period of time. They have actually subsequently recovered pretty well. One of the positives, I guess, is that being an LIC structure, and this is a plus I really believe works well for smalls, is that we could, money wasn't being redeemed. The funds were sort of captive in a sense, which actually works well if you want to invest long term. And so we did manage to rotate the fund pretty well into some stocks and buy more of those tourism leisure stocks that we thought were oversold. I'll highlight Village Roadshow as one example there. It was a $4.
Might have to cut you up. Getting a voice in my ear saying that we've got a minute to go.
Well, it's a very interesting part of my answer, but you can chop
micro caps certainly have rebounded very strongly from that side of things. I might have to wrap up here, although I will note there is a question for Don. From James talking about his LIC, trading at a premium. So I will note that, and maybe we can get back to him at a later stage as to why that's trading at a premium. But with I'd just like to thank the panel. We're running out of time today. In the interest of letting people get to their lunches, then we'll wrap it up there. First, I'd like to thank all of the panellists for their time. It's greatly appreciated. I'd like to thank you online out there for your time as well. Just in terms of CPD points, some of them are probably quite keen to get those. After this session ends, there will be a box that will pop up. You fill in your details there, and those CPDs will come out to you. I think it's immediately as well, so that's always nice as opposed to having to wait a bit. Additionally, there will be a replay of this session available, and that will be sent out to people who have registered and maybe a little bit more broadly as well. But without further ado, then thank you very much for your time, and thank you very much for your time, gentlemen. Greatly appreciated.
Thank you.
Thank you.